Trade wars. We're in the middle of a trade war. Not really. We're in the middle of a negotiation. However, who is weaker in this position? Clearly China. China needs the monster trade surplus that it has with the United States. More importantly, it cannot reduce its massive overcapacity and its high debt without increasing its exports, and it cannot achieve its 6.5% growth either. Therefore, its position in terms of debt of the United States is not a nuclear weapon, and definitely not a deciding factor. We're seeing it in the demand of treasuries. Demand for treasuries is going up, while Chinese markets and China are going down, and Chinese yields are going up. Therefore, what we have is clearly a much more contentious issue than what we probably expected and needs to be negotiated. And what will probably end up happening is that China will have to reduce the trade barriers that it has with the United States and import more from the United States. Another factor, emerging market slowdown. Brazil, we have seen reductions in the GDP estimates. We have also seen reductions in the GDP estimates, in the GDP growth estimates for most of the Latin American economies. And what we need to pay attention is currencies. Currencies are showing us which countries are the weakest. And those that have increased their imbalances the most are the ones that are seeing their currencies suffer harder. And finally, the eurozone slowdown. It is very evident that the details of the data that we have seen for April, for May, the reduction in growth estimates from the European Central Bank show that slowdown is much more evident than what many expected. So what we're seeing basically moderation of overly optimistic estimates of GDP growth and improvements in the economies for 2018, but nothing more. So more exposed to the dollar, more exposed to developed assets, more exposed to defensives. That's what we have to do. Thank you very much.